according to a Financial Times article published on January 30th, 2025. A significant surge in gold shipments to the United States has created a shortage of bullion in London, with traders accumulating an $82 billion stockpile in New York amid concerns over potential Trump administration tariffs. The Bank of England's vaults, typically able to process withdrawals within days, are now experiencing delays of 4 to 8 weeks, according to industry insiders. Since the November U.S. election, traders and financial institutions have transferred 393 metric tons of gold to the COMEX Commodity Exchange vaults in New York, causing inventory levels to surge by nearly 75% to 926 tons, the highest since August 2022. The actual volume of gold moving to the U.S. could be even larger, as additional shipments may have been made to private vaults owned by HSBC and J.P. Morgan in New York, though both banks declined to comment on this matter. The primary motivation behind these transfers appears to be traders' concerns about potential tariffs on bullion imports under President Trump's administration. Michael Hay, head of commodities research at Société Générale, notes that market participants are taking precautionary measures due to fears that Trump might implement broad tariffs on raw materials, including gold. Additionally, the unusual price differential between New York futures and London cash markets has created an arbitrage opportunity, further incentivizing the transatlantic movement of gold. Gold prices have shown strong performance, rising 5% since the year's beginning and approaching their all-time record of $2,790 per troy ounce set in October. Many market participants draw parallels between the current situation and the gold rush during the COVID pandemic, when lockdowns and uncertainty about gold shipments led to increased stockpiling on COMEX. The Bank of England's Governor Andrew Bailey attempted to downplay concerns about the extended waiting times for gold withdrawals, emphasizing London's continued dominance as the world's primary gold market. He stressed that having gold in London remains crucial for market participants involved in trading or utilizing their gold holdings. COMEX gold inventories have experienced a remarkable 36% increase this month alone, with January seeing 244 metric tons of inflows, the highest monthly figure since May 2020 during the pandemic's peak. Traders cite the need to access physical gold to fulfill certain futures contracts as a driving factor behind these movements. Joe Cavatoni, market strategist at the World Gold Council, explains that the movement of gold to New York has been primarily driven by traders trying to get ahead of potential market changes. However, he remains cautiously optimistic that any upcoming tariffs would likely exclude bullion, noting that the administration's rhetoric hasn't suggested targeting monetary metals. The price disparity between markets reached notable levels last week, with June contracts for physical gold on COMEX trading at a premium of up to $60 per troy ounce compared to London prices. This premium has since decreased to $10 per troy ounce as traders have successfully moved more gold to New York, helping to balance the market dynamics between these two major global trading hubs. The situation highlights the complex interplay between political uncertainty, market dynamics, and physical commodity movements in the global gold market, with London and New York remaining the two principal centers for physical and futures trading, respectively.